Provident Healthcare Partners is a healthcare investment bank that is focused on transaction advisory services. We created this podcast for healthcare executives, entrepreneurs, shareholders, and providers who are interested in learning more about the world of healthcare consolidation.
Good morning, everyone. This is Craig Sager with Provident Healthcare Partners, and welcome to another episode of Provident Healthcare Dealcast. Today is September 9th, 2024, and we are on episode number 29, just on the fringe of number 30. And speaking of being on the fringe, we're just around the corner of fall. I don't know about you guys, but I love how everyone in their brains thinks it's fall, but we still have 11 days left, and I'm going to take that in as much as I can. We have a great show for you all today. I'm joined by my colleague, Tommy Spiegel, Vice President here at Provident, who helps spearhead our behavioral health and pharma services coverage efforts. And our featured guest is Sean Hickey from White Oak Global Advisors. On a weekly basis, I probably, along with my colleagues, get asked a myriad of questions around market dynamics. How is the M&A market right now? Are people buying companies with the interest rates this high? What's going to happen if Trump wins the 2024 election? And with that, as a team, we huddled up and we really wanted to tee up a conversation to address the current debt markets, how they're impacting the M&A landscape, how debt impacts deals, and where things are going to shake out in the next, call it 18 to 24 months. We know that debt is not the most engaging topic to talk about per se, but it's a massive part of the ecosystem in healthcare, non-healthcare. It'd be a great conversation today. We brought in Sean from White Oak. I've known Sean for a few years now and thought he would be super educational and invaluable for our listeners as he lives and breathes the debt and credit markets within healthcare on a daily basis. So with that, Sean, would love to kind of hear your personal background, what White Oak does. We'll start there.
Morning, Craig. Tommy, thanks for having me on. As Craig mentioned, nearly 12 years of experience providing debt capital solution to healthcare companies for various lending platforms. White Oak Global was founded in 2007, has about $8 billion in AUM, and provides a variety of financing products to all sectors. I joined our healthcare affiliate, White Oak Healthcare, to exclusively focus on the healthcare sector. We have just over $3 billion in AUM and over 40 employees today. And as Craig mentioned, we're our affiliate, we're 100% dedicated to the healthcare sector. My background, I supported the growth of a lending platform, regional bank, prior to joining White Oak, and also worked for a large private credit fund, Antares Capital, which is currently owned by Canada's largest pension plan, CPP. So significant experience providing financing solutions to various healthcare companies. We currently provide a lot of our solutions to healthcare services and life science companies, not a lot of companies in the healthcare IT market.
And John, and for the listeners, AUM, assets under management, just to give you kind of a breadth of the amount of capital that Sean and his team has deployed, or debt, should I say, deployed across the various healthcare and non-healthcare industries. So Sean, can you give us just a profile or a case study of a business or businesses that you guys call it inject debt into and what that looks like?
Happy to. So I would classify the instances in which we're providing financing solutions into two different circumstances. The first circumstance is we are providing either buyout capital or a recapitalization alongside healthcare-focused private equity firms who ultimately take ownership of various healthcare companies. The second instance is we're providing capital to a management-owned business that does not have a private equity sponsor, and the uses of our debt capital in those cases vary. In some cases, a management team might seek to acquire smaller target in their region. Some cases, they might seek growth capital to invest in R&D, clinical trials, or expand new facilities and expand their footprint throughout the United States. And in other cases, a company who has not assumed any debt to date and has grown their valuation, let's say from 20 million to 50 million to 100 million, might seek to take some chips off the table and monetize their business through some debt and take a distribution for themselves in order to diversify their personal net worth. And so in our case, about 60% of the deals that we do, we're aligning with very experienced healthcare investors, private equity firms that have, in many cases, decades of experience investing in healthcare companies. And then in the other set of cases, we're aligning ourselves with management teams that we believe are differentiated in their given sector.
It comes in a number of forms, it sounds like, Sean. So it could be healthcare private equity firm is looking to acquire a large business or a small business.
Yes.
They don't want to put all equity on the books. They will call up you and your team at White Oak. You'll look at the opportunity, and then the idea is that you'll get the terms with the private equity firm, and you will, lend, quote unquote, lend them the debt for them to help them purchase the business. Or it could be a founder-owned business that's at scale that is looking to grow the business in new markets, new service lines, whatever the case might be. And that will be, again, non-acquisition related, but another way to infuse capital into the business.
Exactly. Well said. And I'm happy to provide a basic illustrative example of a private equity transaction. Let's say a company is being bought out with 10 million of EBITDA for 8 times. So that's $80 million. We, White Oak, may in that case provide up to 3 to 4 times EBITDA, and the sponsor will provide roughly 4 times of the EBITDA in equity capital. And then the remaining 10 to 20% of the proceeds for that 80 million valuation would be the seller management team rolling over their equity into the transaction. That's a very common structure, which creates alignment with the selling management team, the private equity firm, and us, White Oak, the debt capital provider. In those cases, we feel like there's a nearly or close to an equitable amount of debt, equity, and alignment with the selling management team. So we truly become a partner, a financing partner. I like to use that word, and not just a lender, so that we could support the company going forward in their next chapter. And so we're valued by the private equity community for our industry expertise, knowing these various intricacies and industry subsectors within healthcare, the speed of our execution, and our ability to scale with the company.
Yeah, I think it's interesting because I feel like when the word debt is thrown out, it generally carries a negative connotation.
Yeah.
And in certain instances, I think that is a fair take, right? With debt comes risk, and with risk, there's going to be situations where things don't work out. But in many instances, that's really not the case, right? I mean, debt's been around for literally thousands of years, right? And for borrowers or healthcare businesses, private equity firms that are looking to get debt, it's a much lower cost of capital than equity, right? People will most likely rather prefer even a higher interest rate than giving up a big slug of equity in their business. And ultimately, it's a great way to maximize the company's long-term value creation. And again, meanwhile, buyers that are using the debt, like the private equity firms we alluded to earlier, striking the right mix of equity and debt, not just to maximize returns, but to really, I think, make sure the business is cash flowing and it has the right balance is super important. So Sean, I guess, can you just demyth for the listener a little bit, like, debt really isn't that bad, right? And secondly, why is it so critical to the markets as it relates to healthcare?
Sure. I know the Personal Finance podcast will discuss the perils of debt for consumers, credit card debt, student loan debt, and high interest loans for automobiles, how they could crush your financial position and, encourage consumers to pay them down at all costs, right? I think from a business perspective, as you mentioned, debt could be a very powerful tool to accelerate growth, and then as a means of financial leverage for private equity sponsors. I will caveat that by saying when used prudently. The reason I say that, particularly now, given the rise in interest rates, is debt can also be a very destructive tool if a borrower assumes too much relative to the assets or free cash flow that they could potentially generate to support that debt.
Got it. And Tommy, when we think about private equity or organizations that we come across that are contemplating using debt on their deals, how do you see sort of the landscape shaping out?
Yeah, thanks, Craig. I mean, so when we look at it, private equity typically going to use debt for several reasons. Some of this you both kind of hit on, but the first is simply for amplified returns. So by using debt, private equity can reduce the amount of their own equity invested in the business. So if the investment succeeds, equity holders benefit disproportionately as they borrow money to fund the transaction. And this is often called the leverage effect. The second is for risk mitigation. So when using debt, a private equity firm's capital at risk is limited to its equity portion. So if the investment fails, losses are capped at their equity investment. Third is this is probably one of the more important reasons, is really for capital efficiency. So by not committing all equity or all cash, private equity firms can spread the capital they have raised across several investments or use the capital raised to acquire a larger business. But beyond that, debt does have tax benefits as interest payments are tax deductible, and that creates a more tax efficient structure.
Yeah, and I think an example for the listeners would be, a lot of the private equity funds in healthcare, non-healthcare, but the way they think about it is that they go out and raise millions, hundreds of millions, if not billions of dollars from limited partners and high wealth individuals to go deploy into businesses. So if we look at a private equity firm, let's say they raised $500 million in their first fund, and their goal is the average deal size would be around 100 million of enterprise value. If they used cash only, so no debt, well, they're only going to own approximately 5 businesses if you do the averages of 100 million. But when you start to factor in debt as a financing source, and to Sean's earlier example, let's say the cap structure is 40% debt, 60% equity. Well, now that private equity firm has the ability to invest in north of 8 companies. So to Tommy's point, there's a capital efficiency, a diversification that's important as these private equity firms grow their portfolio. I guess, Sean, any takes on that? And then secondly, what types of debt products are, today more or less popular?
All great points, Craig. I don't think I have anything to add about the structures. Happy to walk through various debt products and which ones are becoming more and less popular. For our listeners who are maybe not familiar with the various types of business debt used in the capital markets, you have revolving loans, which are essentially like business credit cards. You draw on them and you can pay them back, often used for working capital and liquidity. And you have asset-based loans, which are loans against hard assets, such as AR, accounts receivable, inventory, and real estate. You have cash flow term loans, which are typically 5 to 6 year loans provided on a multiple of a company's earnings or EBITDA. You have enterprise value loans, which are loans to companies based on the value of the company. In some of the cases, the companies receiving those loans may be losing money and don't have cash flow, but they have enterprise value in the form of recurring revenues, intellectual property, or the prospects of future cash flow value, which would protect the lender in that downside case. Lastly, you have DDTLs, delayed draw term loans. Those are committed capital facilities to companies, primarily used for acquisitions when large companies are seeking to acquire multiple targets over a period of time. You have enterprise values. The enterprise values and the DDTLs, those are less common than they were 2 to 4 years ago for different reasons. The higher interest rates have put pressure on valuations, and there's more pressure for the firms to produce a profit. So, VC capital, for instance, is harder to raise today than in 2021. So that's the reason that the enterprise value loans are maybe not as common. And then delayed draw loans are less common because the issuers, the providers of that debt, folks like me and banks, have to commit that money up front. Let's say it's 50 million DDTL, but if the company doesn't use it, right, we're not receiving any interest on it. So it's very expensive for us to provide those large delayed draw term loans in a high interest rate environment because of the high opportunity cost of committing significant amounts of capital. Lastly, I'd like to talk just a second about the subordinated debt, mezzanine, and PIK debt markets. These are more expensive capital options. They're debt tranches, which are typically subordinated to the senior loans, but positioned above the equity capital and the capital structure. This asset class has made a very strong comeback as companies, both private equity owned and management owned, seek more creative capital solutions. The downside of these debt solutions is that they're very expensive right now. So 12 to 16% total cost of capital. But I think it's important to note that we've seen a real resurgence of this market, relative to these markets are very soft from 2019 to 2022 as senior lenders aggressively provided large, what they call unitranche facilities. The term was coined essentially speaking for all of the senior debt and what would be a small amount of junior capital in one tranche versus two. So the unitranche going leverage, you call it 5 to 6 times, is becoming less common. And, you see a resurgence in these mezzanine and subordinated tranches of debt coming back to the marketplace.
Now, obviously, there's a lot to unpack there. We could probably have a whole podcast on all the different products, but Sean, is the takeaway whether there's a small healthcare company out there that's 5 million of revenue, break even, or a business that's 500 million of revenue and 100 million of EBITDA, two very different ends of the spectrum. There's generally a product out there for them, and like investors do on the equity side, whether White Oak and competitive firms, like the operators will be speaking with a host of firms, and there'll be a lot of optionality, and it's sort of finding the right fit, the right terms to ultimately structure the deal.
Yeah, absolutely true. Absolutely true. And you have different lenders and financing providers in different parts of the market, right? So as you mentioned, a company that's seeking a $2 million loan versus a $5 versus a $15 million loan versus a $250 million facility to support a massive buyout. There's a structure out there for everybody. Finding the right capital provider based on the need and the terms is what they need to do, right, as a buyer.
All right, great. Well, let's hop into what's going on today, because again, I think we are in a higher interest rate environment than I think a lot of us have seen or experienced over the last, call it, decade. And I think on a lot of people's minds, again, operators, investors, payers, etc., are, what does this mean? Should I wait to grow my company? Should I go now, lock something in, refinance later? I mean, there's a million things going through people's minds. Sean, I guess what's your, from a bird's eye view on current credit and debt environment on healthcare, and then sort of versus non-healthcare industries?
Yeah, so that's an interesting question. So I would say we're in an interesting point in time right now because we've seen a pretty massive run up in the Fed funds rate and the baseline interest rates, which has had a significant impact on the companies with significant amounts of debt, their ability to repay it. So on one hand, you have a little bit of deterioration in private credit and in commercial bank lending portfolios, but those debt providers are still sitting on significant amount of capital, and they need to put that money to work, the excess money that they have. Tons of fundraising, and we've had a very healthy fundraising environment in those asset classes for a few years now. With that said, there's been an aggressive push to quality. And when folks see quality, they're looking for businesses that are a little bit more recession proof, that fare better through cycles. And healthcare has been, the cornerstone industry that comes to mind when you think about businesses that could continue to survive in a downturn. And so through this flight to quality, I think a lot of lenders and private credit firms are looking at stable healthcare businesses as a source in a sector in which there's continued interest.
Yeah, I think healthcare nothing's bulletproof, but it's more bulletproof than other pockets in other industries. Sean, are there any specific verticals within healthcare? And again, I imagine each lender has a different perspective, but you and your team over the years of your experience, that are better opportunities, more attractive. Again, there's healthcare services, there's pharmaceuticals, there's med devices, there's healthcare IT. Even just looking at healthcare services, physical health, behavioral health, any ones that pop out to you as either a safer bet or potentially a profitable bet?
You mentioned a couple of them. When you think about behavioral health and the payer sources and the critical nature of services, somebody with a substance abuse issue is not going to miss their appointment, unfortunately, right? So, and fortunately for them. So they're kind of critical services, and then there are what we classify as discretionary services. And even when you look at some of the physician groups, as we evaluate dental, for instance, I'm not going to miss my every 6-month checkup. I'm not going to miss a oral surgery, but I might not do a $400 whitening, or I might not do Invisalign, right, which is a more consumer-oriented component of dental. As you think about procedures, within the physician practice sector, the procedures which can't reasonably be delayed are going to be resilient in a downturn. The procedures in which you could consider a delay if there's a significant amount of out-of-pocket cost and not a horrible pain or imminent nature associated with that procedure, those could potentially be deferred. And so I think, generally speaking, physician businesses, less on the consumer-oriented side of healthcare, behavioral businesses, companies that provide care in home health settings will continue the volume through any sort of downturn. And a lot of that comes down to the payer dynamics associated with.
I was going to say, I imagine you guys take a really close look at the funding sources. A government funded business, whether that be Medicaid, Medicare, is again a little bit stickier. I'm generalizing across all of healthcare versus the commercial population, or to go even further down the spectrum, cash pay, right? Where it's
correct,
much more elective in nature.
I think that's exactly right. And when you think about what is going to happen in a downturn, well, first off, unemployment increases, right? So what does that do to your addressable market of commercial beneficiaries? They decrease. So if you're looking at a provider that has higher reimbursement on the commercial side of their business relative to Medicaid, ACA, or Medicare, well, you might actually have a mix shift. But what does that do to the profitability of the company? You mentioned cash pay. Have to expect that business that is 100% cash pay, that relies on folks coming out of pocket for derm procedures in a downturn, when folks don't have as much disposable income available to them, they might seek to defer or reduce the amount that they're spending on those sort of dermatology cosmetic procedures. And so you nailed it. I think there are a lot of different considerations associated with these various subsectors, but a lot of it comes down to the payer source and the quality of the revenues.
Yeah, Sean, it makes a ton of sense. I guess, what about businesses sticking to healthcare services that are 100% funded, cash pay, or by the consumer? So there's no coverage from commercial or government payers, i.e. plastic surgery, med spa, IVF, and a host of others, where, IVF, plastic surgery, med spa right now are hot spaces. We get calls a lot from private equity investors trying to find a business at scale they can deploy capital into. How would you and the team at White Oak profile a business like that? How do you get comfortable, or another lender get comfortable deploying debt into that business?
That's a great question. I think the answer is, you're seeing this type of investment into those sectors due to the long-term, secular trends, which all point to growth in the sectors that you just mentioned: IVF, med spa, some of the more consumer-oriented businesses. I think that they are, more inherently risky in a recession. With that said, I think the bet from the investors and then the lenders, the private capital providers, is that many of the procedures that you might see during a session that go away or decline are just simply deferred. And so if we go through a 2-year recession and the volumes declined for a couple of years, the bet is basically that the volumes will return in the subsequent years when people are able to afford them. I don't think a recession changes a family's desire to want to have children. And so, when people look at IVF and the demand for in vitro fertilization and proving the shots at a pregnancy, that's a family decision that they might wait a year, they might wait 2 years, depending on their family fiscal situation, but they'll ultimately spend the money. And so I think the bets are, in those sectors from the private equity community and also the strategic investors, that we're investing in industries which are growing secularly, And then from a lending standpoint, I think that the downside cases just need to be tested, right? You need to think about, can they service the debt during periods of softness where volumes may go down and profitability may go down? And then can they get to the other side?
Makes a ton of sense. And again, like anything in life, it depends. It's situational. Every business, every sector is evaluated differently, but wholeheartedly agree. I think some investors and then lenders are trying to go where the puck's going. So in terms of threading the needle with the conversation on the current debt market, let's bring in what's going on in the M&A world today and what's transpired over the last, call it 5 to 10 years. Tommy, you want to just, for the listeners, unpack what we and you have seen? As we know, right, debt market impacts deals. It's not the only variable, but it's a variable and an important one. What have you seen from whether it's a deal count, size of deals with debt, without, over the years?
Yeah, definitely. So when we look over the past decade, healthcare services M&A has definitely experienced significant growth and even transformation due to several market drivers, such as the increasing demand for healthcare, rising costs, changes to reimbursement, and notably an aging population. Private equity firms have also increasingly invested in healthcare services because they look for stable returns in a highly regulated but resilient industry. So over the years, private equity-driven deals have surged in areas like physician practices, behavioral health, post-acute care, and then more broadly speaking, just outpatient care. So when we look at some of the numbers, from 2015 to 2020, deal count as characterized by private equity and strategic buyer investments increased from around 2,400 per year to 2,600 per year. And over that time period, median deal sizes were just a hair under 30 million. In 2021, deal counts spiked to almost 4,000, with the median deal size also increasing to around 35 million. Since 2021, deal counts have decreased annually, but still remain, above pre-COVID levels. When you look at over that time period, from a usage of debt perspective, estimates suggest that upwards of 80% of healthcare services M&A deals utilize debt financing, but those estimates can vary by subsector. So sectors with the highest use of debt include behavioral health, home health, and DSOs. More moderate use of debt is subsectors like physician practices and ASCs. And then the lowest use of debt includes, more venture capital-ish areas like telehealth and digital health platforms.
Tommy, yeah, those are some interesting numbers. Good to bifurcate pre-COVID, post-COVID. So 2021 was certainly an outlier, not just in healthcare, but other industries. A lot of deal flow. I think people were rebounding COVID where things were really down, obviously. I guess when you think about even 2022 through today, the deal count, the size of deals, the amount of debt is still higher than 7-8 years ago. Why do you think that's the case? I mean, is it private equity is just sitting on more dry powder? There's more firms out there. There's private equity firms that have a lot of businesses in their portfolio they need to sell. I mean, what do you think is driving that increase in deal count?
I mean, you hit on a bunch of great points there. So the first is, the sheer level of private equity dry powder out there. Level of available funds has increased every single year over the past decade. And this even accelerated in the first half of 2024. So as of July, global private equity firms held over 2.5 trillion in dry powder and added almost 50 billion to that pool since the start of the year. The driver here is that, an improving M&A environment has opened up more opportunities to deploy that capital into buyouts and other types of transactions. So another factor to consider is private equity hold periods. So this is somewhat sector specific, but a lot of platforms established pre-COVID were held for an additional 1 to 2 years, where typically PE is going to target 5 years for a hold period. We are seeing upwards of to 7 years currently, where longer hold periods can speak to the uncertain direction of the economy or even a value mismatch between buyers and sellers. So as an example, In the autism services space, we are tracking that 65% of PE-backed platforms are 7+ years into their hold period. So over the next 12 to 18 months, we expect a lot of these platforms to trade to their next private equity sponsor as market conditions continue to improve. Another trend, and that's quality versus quantity of deal flow. Buyers may pass on a higher volume of average quality deals and focus on a smaller volume of high quality, strategically valuable targets. So high quality assets that have strong financial performance, market leadership and unique positioning, scalability and growth potential, and a strong management team will continue to be in higher demand. And then one last factor in deal flow in the future is simply the use of de novo growth versus add-on acquisitions. So within certain subsectors and even certain markets, PE-backed platforms have opted for de novo growth, as it can be seen as a cheaper alternative to add-on acquisitions. For a cat dry powder and improving market conditions to speak to elevated deal flow, while some of these longer hold periods in the short term and then buyer pickiness for higher quality assets may hinder deal flow. But what continues to remain true is that there's still a very strong market for high quality assets.
I think everyone likes and wants to say an organic playbook is the best outcome or potential return on investment. And it's hard to disagree with that. But at the end of the day, these private equity firms have a shot clock. And that's normally 5 years. It's trending more towards 6 or 7 these days. But without doing significant amount of add-ons, it's not a bad thing not to do those, but it does limit your ultimate scale and growth rate. Sean, I guess we're talking about a lot of deals getting done 2021. We all know where the interest rates lie today. How is this happening?
It's a great question. I think the flight to quality that Tommy mentioned is a really important point in the debt capital markets, in addition to private equity right now. You know, the ratings agencies, Moody's, S&P, and Morningstar rate debt capital in the middle market and the upper middle market, typically companies seeking to do larger raises. New private credit ratings assignments for Morningstar increased 82% year over year during the second quarter. In the first half of 2024, nearly 95% of new ratings were B or higher versus 79% in the first half of 2023. So if you look at that, the issuers are focused on committing capital to quality companies, which, as Tommy mentioned, are well diversified, to position to weather potential economic softness over the coming years. Private equity firms are getting these deals done, in many cases, with slightly lower leverage. Some cases, they're coming up with new alternative capital sources. As I mentioned earlier, resurrection of the mezzanine and the PIK debt markets, potentially using lower cash interest debt in favor of payment in kind, non-cash interest, so accrual debt. Some cases, they're asking the management team to roll over a higher portion of their ownership into the new transaction, which does not cost any debt or equity at close. And in other cases, they're structuring the deals with earnouts, right? The ability for the management team to earn more proceeds in the form of potentially debt and or equity, subject to certain performance hurdles in the future. So I think you guys use the word structure, right, Craig? I've heard you use that word many times. The answer is they use debt, they use equity, and then now they use a little bit more structure. Would be curious to see what you're seeing as well.
I think that's right. I think at the end of the day, I mean, the whole theme we hit on earlier is private equity and large strategics, whether they're PE backed or they're public or just are a big company with a lot of cash on the balance sheet. They want to grow. They need to deploy the capital. Having it sit in their bank account isn't doing much good for anyone. And so we've seen a good amount of creativity. I mean, we closed a deal earlier this year at the beginning of April. It was a sizable deal that most private equity firms would have layered a good chunk of debt on it. Given the current environment today, which isn't the worst, but it's not as favorable as it's been, the buyer opted to write 100% cash or equity check today. And the goal is, as they continue to grow that business in their market, in the other markets, they will refinance down the road. Now, obviously, there's a lot of what ifs in that scenario, but the buyer was not going to lose this deal. It was a competitive process. because the interest rate was a little higher than they wanted. They could have done it, but they opted to go that path, which I think we've seen in other situations. We'll continue to see that being an option for groups. So agreed. I think deals are going to happen, and it's a matter of risk tolerance and what's best for you and the team.
That's interesting, Craig, and not surprising. If you look at the expectation for rates over the next year to 2 years, I think the market is pricing in a decline, and many buyers, right, are expecting a decline in the Fed funds rate, right? So they might seek to front the money with all equity now and then obtain a lower interest rate and a more favorable debt market in the near term.
Yeah, and Sean, just for the listeners, if a private equity firm or a buyer is looking at an opportunity that they like, what kind of goes into the underwriting? Like, are they coming to White Oak and other banks trying to figure out what is the best terms, the best pricing on the debt? How does that process work?
Yeah, the answer is it depends. The large deals, more institutionalized, large private equity firms, many of them have their own debt capital markets function, which will go out to anywhere from 8 to 12 lenders, solicit terms in a very competitive and narrow process. Lenders are expected to submit term sheets, and almost similar to the way that you guys run a auction for a business to find a best option for a management team, those private equity firms will seek to solicit the best terms on the financing side. In the lower part of the mid-market, companies with EBITDA lower than 10 million, it is a little bit more specialized and less formal of a process. I think a lot of the private equity firms and companies will really seek to rely on the industry expertise, execution ability of the lenders. And it becomes a little bit more of what we call a specialized process. So that's why when I think about what we do, it is a little bit more in the specialty finance world, where the value of the relationship, the knowledge of the healthcare sector, and our ability to support that company's growth long-term becomes very important.
The way I've always thought about it, maybe this is informal perspective, but when a buyer, again, private equity firm, large strategic, wants to buy a business or go raise dollars for future growth for an existing portfolio company they might have, whatever it might be, they're ultimately selling the lenders, and to a degree, their LPs, like, on the opportunity. But it is the lender's call at the end of the day, and they have to get comfortable. So it's sort of like it's a partnership and a collaboration to get everyone comfortable. Because at the end of the day, no one wants to over-lever a business. It's not good for any of the stakeholders. Yes, the lenders in White Oak, et cetera, need to make a return. You don't want to have a situation where the business is upside down from a cash flow perspective. In terms of getting deals done and thinking about lender tolerance in terms of into the underwriting, Tommy, what have you seen in terms of how this process unfolds? What's acceptable in today's world versus maybe what's not have been 6 years ago?
Yeah, definitely. I'll start, and then Sean, would love to get your perspective on this as well. But so, 5 or 6 years ago, we saw a lot of pro forma and maturity adjustments. So, for example, a lot of behavioral health, or more specifically autism services deals, receives full maturity credit for newly opened centers. Today, that is not so much the case. Today, most pro formas we are seeing relate to really just payer rate adjustments, and even that is sometimes slightly offset for rising provider costs. We are also seeing acceptance of run rate adjustments and break evens for new centers, but that depends on the situation. Sellers really need to have a proven history of ramping regions or centers to successfully receive credit here. But Sean, what are your perspectives on this from the lending side?
Absolutely. You made a lot of great points. Prior to COVID, you had an acceptance of very aggressive pro forma adjustments on behalf of lenders. I'll give an example. If a dental business was running at a 22% EBITDA margin and acquired several new centers or started several new centers that may have not even been profitable, the lender would permit an EBITDA adjustment in an amount of the existing business's margin, right? So if the DSO acquired $10 million of revenue, but that margin was 10%, they would still get credit for a 22% margin as if acquisition was running at the same margin as the existing business, with the assumption that the DSO could get that margin there over time. You mentioned de novo maturity adjustments. So in that case, in the autism service industry, another great example, I just opened the lease, right? We have a lease in, we put the flag in the store. A lender might accept a full pro forma adjustment as if that clinic has been running for 3 years, right? So you're providing the full revenue and the full profit margin to the EBITDA, and then lending debt capital, or at least managing the covenants and the structure of the loan to that level. I think on a couple things, namely the healthcare staffing crisis and the inability of many of those platforms to find staff and hit those pro forma adjustments. And in some cases, they did hit them. In some cases, they didn't. The market has swung a little bit. I think the lenders are taking a little bit more of a finer look at the ability of that company to generate that revenue, looking at a little bit more closely at the history, each of the given clinic's performance historically, and whether or not they could reasonably hit that pro forma adjustment. If they can, and the lenders buy into it, it's typically capped by a dollar amount. And so there's a little bit more structure around the adjustments that are being permitted in documentation in today's lending world.
Sean, that's a really good example on the DSO, moving the margin from 10% to 22% in an Excel spreadsheet and thinking that's just going to come to life. And sometimes it will. It could, maybe it'll surpass the 22% margin. But when it doesn't, whether it's a staffing related issue or just a operational or clinical issue, people can be in trouble. And I think even for operators or groups who work with that, they're trying to maximize enterprise value. Who is it, right? We're all capitalists here. But when a private equity firm isn't comfortable underwriting to run rating at 22% margins, or the lender isn't, even if the seller or the business wants it, even if you got it, right, and you got that enterprise value, well, now there's just a lot of pressure to perform. And once you don't hit those margins and you're tripping debt covenants, it can be a world of trouble, right? So sometimes there's good reason why people aren't getting the enterprise value they want or they think they want and need. But at the end of the day, cash flow is king. And yes, for great assets, buyers might get emotional. They might step up in price. They might write a bigger check because the lenders won't get there. Those things happen, but the quantity of those are few and far between.
I was just going to say that as it relates to lending, just to put things in perspective, in 2018 and 2019, we had a 0% federal funds rate. So we lend money on it used to be LIBOR, now it's SOFR base rate. And when the base rate was 0 and your rate, which is the SOFR plus the 500, 500 is 5%, your interest rate was 5%. We went through one of the most dramatic and rapid increases in interest rates in history, where that 5% over SOFR is now the equivalent of 10% in cash interest, with the rise in the base rate to 5%. And so your cash interest percentage wise doubled, even if you have the same loan document from 2019. And so what that means is if you have $100 million of debt and your interest expense was $5 million, today it's $10 million. And so I think that can't be emphasized enough, is really just the cost of the debt. And the ability for the companies to service that debt becomes all the more important. And so you're really just looking at, okay, great, we use this number EBITDA. We talk about EBITDA all day long, but cash flow becomes just as important, if not more important, when we look at the business's ability to collect on their receivables, manage their working capital, and have enough money on a monthly basis to make the payments. That's really the governor today. It's less about leverage, and it's more about, can this company service the debt with their existing free cash flow?
And last question on this topic, just in terms of time horizon, Sean, that gets you and the team or another lenders comfortable, what you've seen from that EBITDA or cash flow. Tommy and I, generally speaking, most transactions, it's a trailing 12 months. It factors in seasonality. 12 months is a generally representative of where the business is today and can go. I think we have seen shorter time horizons. I think our sellers all want that. In today's market, what is more customary?
I think 12 months is still the standard. With that said, there are situations where we look at shorter time horizons. I think those instances are where the company is in a high growth profile, right? Where the current performance today in September might be more indicative of the expected performance of tomorrow based on that company's historical track record of growth. Now, I emphasize that because a lot of companies who have experienced the same amount of revenue or had fluctuations in revenue over the last 5 years, they all of a sudden have a great month, right? The current month might not be indicative of the future. Now, if this business is a high growth business, 20 to 30% growth profile, and the census levels are higher today than they were in January, and we'd expect that the census levels are sustainable and will continue to increase based on that company's growth forecast and their strategic plan and the current performance of the existing centers or staffing ratios, and if it's a home health business, then we can lean into a shorter time period. Very rarely, or you don't ever get a 1 month run rate, but we might assess a performance adjustment for the recent performance of 3 months or 6 months. Again, it depends on the profile of the business.
Yeah, I think we've done a good job talking about what a firm like yours does, Sean, where the markets are today from both a debt and M&A and how they really intersect. In terms of where we're going, I mean, we've got a few things coming up the pipeline here that's quite interesting. We're getting a lot of questions. I mean, we've got a Fed readout and meeting on the 17th and 18th of this month, so we're a week away. And then obviously what's overarching, I think a lot of people's minds, forget about M&A or debt for a second, but in general is the election coming up here in November. People are also asking, is there a recession on the way? So a lot of things to think about. Tommy, I'll start with you. I mean, a lot of variables here, a lot of what ifs. How do you think even something like the 24 election impacts M&A, debt markets, what have you?
Yeah, it's a good question. So ultimately, there is a tax and regulatory impact from an election. But when you look at deal count, particularly in healthcare, the change is small. So in short, there really isn't much of an impact. You could sit here and argue that elevated levels of uncertainty leading up to an election may delay transactions due to potential policy shifts because, the media and other sources of information really don't hold back putting in your face how maybe Republican pro-business deregulation policies or even Democratic pro-consumer pro-regulation policies may impact deal flow. But the truth of the matter is that M&A activity is primarily driven by the macroeconomic cycle and to a much lesser extent, the election cycle. So if you look at data of deal counts over the last 20 years around an election, there really hasn't been much of a change in deal count during an election. But that being said, Sean, what are your perspectives on this, and how does this election specifically and the primary policies of the current candidates compare past elections? Are there any considerations for M&A volume post-election?
Great question. In healthcare, unlike the prior election, there is no transformative Medicare for all risk currently contemplated, even after Vice President Harris became the Democratic nominee. But that doesn't mean that the election is without healthcare consequences and risks for various sectors under either a Republican or Democratic president. There are also implications of the Senate and House elections that could stack either one way or the other and also impact some of the regulation that we could expect over the next 4 years. I think the headline, though, is from an M&A perspective in healthcare, I think we could agree that there's no massive risk that would shake up or deter anyone's thoughts on a sale process or doing a deal over the next 12 or 24 months. But with that said, in various sectors under either a Trump or a Harris victory, there are definitely consequences.
So let's just imagine a world where Trump wins, Sean. What are maybe it's short-term impact as it relates to M&A, debt, et cetera?
So I think it's more sector specific, right? Because if Trump wins, you think about regulation, FTC, movement on corporate tax rates. Those types of dynamics would likely be favorable for M&A. There are considerations at the subsector level within healthcare that we all should consider. I think a Trump administration would likely seek to reverse or simply just not follow through with some of the legislation that Biden has pursued and proposed, including the nursing facility staffing rule, LDT final rule on diagnostics, home and community-based services, Medicaid pass-through requirements, the FTC non-compete ban, and others. I think it becomes a little bit more sector specific. The two other dynamics I'd like to mention are the enhanced ACA subsidies is one of the key 2024 election variables. The ACA exchange lives has had a disproportionate impact on the non-Medicaid expansion states, such as Texas, Florida, Tennessee. It's about 20 million covered lives in the United States right now, and that's up from about 11 million lives in 2019. So there are a number of different political outcomes based on a Republican or Democratic House and Senate, which could either reduce or increase the likelihood of an extension of the ACA subsidies by Democrats. Medicaid work requirements are the other ones that the Republican Trump administration might pursue, which could kind of narrow the Medicaid lives in terms of the criteria for eligibility under a work requirement by permitting the states to essentially put in place a work requirement based on their waiver program. Those are some of the big ones.
Yeah, that checks out, and all good things that I think are on people's minds. What about, I guess, just the term recession, I think, is also getting floated out there. I mean, listen, by definition, a recession is when the country has 2 consecutive quarters of falling GDP, which is not a good thing, but it feels like the term is, again, so negative in nature. I guess, Sean, Tommy, what are your guys' takes on this? If a recession, by definition, does come to fruition in the coming months or into 2025, is that a dramatic impact on M&A activity or debt markets?
Thanks, Greg. I could start with that. I think anytime you see headlines of a recession, any chief credit officer's nature is to take a finer look at any given opportunity, right? And so that might increase some selectivity on the debt financing side if we do go into a recession, as lenders and private credit providers may seek to pivot toward really focusing in on their existing portfolio and managing the implications of a softer economy than their broader portfolio. So probably not a super positive on the debt side. What basically is being modeled in, though, right now with the rate cuts is a modest increase in the unemployment rate, which continues to be at a historic low. Candidly, in the healthcare world, a modest increase in the unemployment rate, I think would be welcomed. If you look at, the staffing crisis is still not yet over, and so that may bring some folks back to work and improve the healthiness of the labor market within healthcare, where skilled and unskilled workers are hard to come by.
Well said, and certainly makes a lot of sense. Yeah, gentlemen, we've talked a lot today about some important topics. Again, we could go on for hours here. Anything else you guys would add in, maybe anything we missed or glossed over today?
Nothing for me, Craig. I just want to say thank you again for having me on today. It's been a real pleasure, obviously, working with you and the rest of the Provident team. You guys continue to be industry leaders in healthcare and always enjoy our conversations. So really appreciate the time.
Likewise. Appreciate that, Sean. Yeah, everyone, please check out White Oak. Sean and team are doing a lot of great work. Hopefully this was additive, regardless of where you stand in the healthcare ecosystem. Thanks, everyone, for tuning in for another episode.